we're seeing a rise of inventory. We're seeing a slowdown to the number of days that it takes to put a property in escrow. We're seeing an increase to the number of cancellations. And all of this is a feeling that is vibrating through our local industry, our local area. And that applies to our loans and that applies to our housing. So what does this mean to you, and how is this in relation to the rest of the country, the rest of California?
Welcome to Local Living Tri-City, your go-to podcast for exploring the vibrant communities of Temecula, Murrieta, and Menifee. Join me, Liz Jones, as we dive into real estate insights and local business stories, bringing you closer to the heart of our Tri-City area. Let's get started with today's episode.
Hey everyone, my name is Liz Jones. Welcome back to Local Living. Today we're going to talk about market insights as of March 2025 in the Southern California Inland Valley area. So thanks for joining us. If this is insightful for you, please do share this with someone else you know. Click the like button. We'd love to have you there. I just would like to bring to light, we're seeing in our group, we're seeing a rise of inventory. We're seeing a slowdown to the number of days that it takes to put a property in escrow. We're seeing an increase to the number of cancellations. And all of this is a feeling that is vibrating through our local industry, our local area. And that applies to our loans and that applies to our housing. So what does this mean to you, and how is this in relation to the rest of the country, the rest of California? Well, let's see if we can break this down and talk about it and see what we can do and how you can best prepare. So as I go meet with people, I'm hearing more and more that folks are looking to capture their equity before there's a change. They're feeling a wee bit uneasy about the economy for several reasons. It could still be increased interest rates, maybe the rise of costs for insurance here in California, which has played a huge factor, especially since our fires that took place in LA. We know for sure that we're going to see a huge impact to our housing, and that's our monthly costs that will come in the form of insurance. So twice a year we have our taxes due. People are feeling that, our property taxes due. And with all the changes in administration and the speed at which administration is making changes, this starts to make people, regardless of which way you voted, feel uneasy. Now, is it a bad thing? Who knows? We'll know a year from now, but it feels like disruption. And disruption gives us all reason to pause and slow down and think twice about what we're doing. And that is what we're seeing in the market. I see it in a form of my listings. When I meet with people, they're asking to capture that equity, that they need to get the maximum out because this is their last hurrah. Let's say they're downsizing, and they need to have that equity to live forward. I'm also seeing a pause from my buyers, my young buyers, who are now being asked to manage a $4,000 to $5,000 payment for an average home in Southern California. And whether you're military, they may only be giving you a $4,000 budget and you're living in Southern California. That is not enough. So you're having to make an extra dig into your pocket to come up with extra resources. And where does it come from? So they're sitting back and pausing for a while. In that difference is what's causing some of this disruption. So in January, we saw that the number of homes increased from December to January by 2%. That's the number of listings, active listings went on the market. That picked up again, 44% higher in February. So from January to February, 44% increase of the number of homes on the market. Now, if, in theory, and it is, taking longer for you to actually sell a house, it was typically under 30 days, 20 days, even 10 days when inventory was tight. So you would have a house on the market a week later, you'd have an offer on that, and it usually continues and closes escrow. Now, when you have new inventory come to the market in January and it doesn't sell, it's going to extend into February and not have a buyer. And then you bring in a whole new collection of of listings into the marketplace. That's that 44% increase. So now you've got this tremendous pot of listings that need to be sold, but the time to get them sold is extending. So we've moved to probably around 52 days in this local area. So you might be on the market up to 52 days before you have your buyer. And that's got people a little uneasy because the last 4 years, we have seen an inventory shortage, and that gave sellers a very comfortable feeling that they put their house on the market, they can get their price, and they move on. That's changing. And we're not used to that in California. So, with that kind of uneasiness comes anxiety. Now, they have a little bit of anxiety coming from the economy, a little anxiety coming from administration, from interest rates and future rising insurance costs. And then you have the house sitting on the market and it's not valued at what you thought it was, because we've been in an incline every month over month, prices are rising. But now we're finding that our appraisals are coming in lower, that our appraisers are not agreeing with the price that keeps increasing. We're finding that because the payment's so high, there's fewer buyers in our buyer pool to buy these. And because there's uneasiness, there's again fewer buyers in the buyer pool. And sellers honestly have continually believed that the house was going to increase. For the last 5 years, it has. But now that there's more inventory on the market, they're finding that those prices are not solid. The ground beneath their feet is not solid. And so I can't give you enough answers of how many times people say, well, what's the number I'm going to sell at? But I really need this number. That is not going to get your house sold. And in this kind of shift of market, I'm not sure I'm confident where your house will sell. It's about the timing, the condition, the location, and the price. So let's look at some numbers. So there's something called the Unsold Inventory Index, UII. And for January 2012, the Unsold Inventory Index in California, okay, measures the number of months needed to sell a current supply of homes at the existing rate. So in December, it was 2.7 months of supply. There were 2.7 months of supply to get to a buyer or get to a sold sale. That increased in January up to 3.2 months. It took 3.2 months to sell a home. And in March, we are already up to 4.1 months in order to sell a home. That's 120 days. Now, this is all of California. So in our area, I did a study right before we jumped in here. We're at about 52 days, but you can see we're talking 190 to 120 days for the average California to get a house sold right now. All right, in our local area, we're looking at 1,928 homes currently on the market in Inland Valley. Now, I've used 5 cities: the Murrieta, Temecula, Wildomar, Winchester, Menifee. So we've got those cities. There's currently 1,928 listings as of this taping, and the average days on market we just mentioned is about 52. Okay, so the number of homes that were sold, now they use this equation where you take the number of homes sold divided by the number of houses on the market, and you come up with that index. So in Murrieta, in February, that's January and February, there were only 65 homes sold. And last year at this time, same time frame last year, they were at 91. So that's down a third. So in the Winchester area, for example, this year there's 42 homes that have sold year to date. But as of last year, same time last year, there were 60 homes. Again, that's down significantly. In the Wildomar, interesting enough, this is an interesting one. In February of this year, there were 18 homes sold. It's a much smaller city. And that's an increase from last year at 17% up. So why, I'm not sure, but consistently we're starting to see a decline, a change. Now, again, we want to talk a little bit about why there is a change. So the things that keep buyers at bay, okay, there's rising interest rates. obviously the higher mortgage rates. We will see 2 more cuts for the rest of this year. However, borrowing is getting very expensive, and the monthly payments are getting high. And the longer these houses are on market, the buyers are going to negotiate. We start to see a slowing of the economy. There's concerns all over the place about recession. We probably have been in a recession. We're a little flat for the last 2 years, but we're not calling it a recession. We'll probably, or just call a spade right now. We are experiencing this across the board, whether or not you're in the trades, whether or not you're in housing. I am hearing this across the board from people that they're more running in place. We're keeping busier and not making as much money, or are seeing our margin shrinks because our material costs are rising. So we have to squeeze our service costs. So that's slowing down. So rising insurance cost, flood, fire is significant. Higher insurance costs increase the total cost of ownership. So in this area, I have a property on the market currently who pays $31,000 a year for fire insurance or hazard insurance. They have the house paid off in full, but they must maintain, if they want to be repaid in case of damage, $33,000. I personally pay $8,000. I'm anticipating a increase to $12,000 this year. That's $1,000 a month. And an average home may expect to pay $500-$600 a month that's set aside for hazard insurance. All right, there's a lot of job uncertainty. There's been some governmental cuts. There's some cutbacks. There's lagging profits. Corporations are making those changes. There's just a lot more fear in the air. Rising insurance costs, we talked a little bit about that. Increased housing inventory. Okay, so a growing number of active listings without matching a buyer to that shows up as oversupply. And it takes homes longer to sell, and sellers are often having to take some discounts or change the price that they had once before. And most importantly, and we'll go over this in a minute, this often marks a shift from a seller's market to a buyer's market. Yeah, it has been one of the longest running seller markets in a long time. We have had a very short supply of inventory, and we'll talk a little bit about that later, but we may be seeing a shift to a buyer's market. So in addition, we have fewer qualified buyers. So stricter lending standards can increase that. And cash buyers may be pulling back from the market when they're starting to see a decline. They're certainly not going to come in with their $300,000 to buy this house when it's going to make more money in the market in like a CD or some other way, because as prices drop, they're going to be losing money instead of building on that. So you're seeing our cash buyers start to pull back, our investors starting to pull back. There's just not enough profit in it for them. So we're also seeing a decline in the pending sales or closed sales, a consistent drop month over month. And this indicates a waning of demand, especially when paired with longer days on market. It reflects buyer hesitation. So price reductions and appraisal gaps. So the increased price reductions signal that homes are being overlisted and not fetching their asking price. I know I've specifically have seen recent where I have a house on the market at X price. The buyer needs closing costs. We have padded the price to reflect closing costs, selling at this number when it's really worth this number. That's a thing of the past. So when the closing costs aren't available to our buyers, they cannot participate, and therefore that house sits on the market. So our appraisers are getting, they were feeling good about going up because the market was still increasing in value. But once we are pulling back, those appraisals that can allow for a cushion, they may be a thing of the past. All right, let's look at some of the average price cuts in California. The overall market, recent data indicates that the sales to list price, so the ratio in California, has been typically 100%. You put it on the market, you sell it for right around that number. That's why the ratio is at 100%. So the average homes, this is in the average home price, without significant reductions, 2 point. And this is kind of the San Diego, using San Diego and local area housing. However, in the higher price homes, those over $800,000, although I don't have a ton of data on it, it is showing that often there is a discount, so to speak. So if you're at $1 million home, they may be offering you 950, so that's a $50,000 drop, and they will see bigger drops proportionately from your average priced home. And of course, there are fewer $1 million buyers versus the average where everybody's in, they're all competing with everything. So you can take that into consideration. How long have we existed in that seller's market? In other words, there's a shortage of inventory to the number of buyers, therefore a seller's market. So what we're finding, we have largely been in a seller's market since 2020, and it was fueled by low interest rates, record low inventory, high buyer demand, remote work flexibility, that's changing too, and an influx of investors and cash buyers, just adding to the buyer pool, right? Even as rates began to rise in 22 and 23, home prices remained relatively strong due to a persistent inventory shortage. Think about it. People got 3% interest rates. They're not moving, right? Sometimes life forces you to move, or sometimes you just can't maintain this very expensive house for whatever reason, insurance costs, taxes, whatever, and you can't. So you've got to get rid of it. You don't want to, but you have to. You take your equity and you go someplace cheaper. Now we're seeing those homes come back to market, people moving for one reason or another. And so that has been why we were in a seller's market. Now that's changing. 4 stages of what it looks like to move from a seller's market to a buyer's market. Now, this is pretty cool. There are 4 phases, and it usually ranges over 7 to 10 years. There's a recovery phase, okay? This follows a downturn, low prices, slow growth. People are still scared, still worried that there's more drop involved. And then the investors start to come in, right? They see the writing on the wall. They start buying the properties, start flipping the properties, and slowly but surely people gain confidence and the buyers come back in the market. It sends our journey upward. There's an expansion market. That's where inventory tightens down, right? Demand rises. That was where we had 3% interest rates. Prices climb as a result. Multiple offers make it. I want buying, closing costs, etc. And new construction ramp up. We've been seeing that where you can't even turn sideways and you see brand new construction going on. And they plan this far in advance. But we have it's just an oversupply right now of housing, brand new housing, and they've been building up to it. We've been in an expansion phase to this point. And then you come where we are now. It's called hyper supply. So we had recovery, expansion, hyper supply. So this is where overbuilding occurs. We've got standing inventory by our builders out there. You got inventory exceeding the demand. We are now going longer days on market, more properties coming on the market. We're seeing everything start to slow down, and then prices flatten or drop. I'm seeing across the board discount, 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 discount. So it's happening now as people are forced to sell or want to sell before it starts sliding downward. They are making the price cut adjustments that they need to put the property into a very attractive place where buyers come to buy. And then, of course, what leads recovery, expansion, hyper supply is recession or correction. So this is a very interesting thing. Prices start to slide downward. The days on market starts to increase. Remember, we talked about it. We went from 10 days, now we're up at 52 in our local market. Inventory grows. My typical inventory is between 6 and 7 houses every single month. I have put 15 up in 3 weeks. So that's just giving you an indication. I'm more than double my normal amount coming to market. Buyer demand wanes. Fewer people are able to buy. So it appears, okay, that California, Southern California in particular, here, I could speak to that market, is in the early stages of hypersupply. And as the inventory begins to rise and the buyer demands soften. So what does that mean to you? and how should you be thinking about this? So if you feel that this has been a time where this is your moving year, okay? I want you to seriously think about when and if you put your house on the market to price it correctly. Price it where it's going to sell within the first 30, 40 days because it's priced correctly. Your professional will know how to make that happen for you. Can't share how many of my clients have a number before I even arrive. How so many of them are using Zillow or a Realtor or Redfin. And let me tell you, those numbers are all different. It pinpoints a place on a map, draws a circle, and says, here's my average. And I have so many of my clients think this is their number. But condition makes a big difference. Location, do you back up to a busy street? Are you in the middle of Timbuktu? Do your neighbors and you have, things working together? Do you have a rickety old fence? Does the inside torn up? Are you still in carpet and when everybody else wants hard surface? There are so many factors that make pricing specific. And so I want you to keep that in mind when your professional comes to you and asks you or tells you a suggested price. She's trying to help. He's trying to help. Because in a downturn market, the longer you're on the market, the many more thousands of dollars you lose. So typically, if you start, let's say at 500,000 and we're in a declining market, your house could be worth 490 in 2 weeks, 480 in 3 weeks, or 70 in 4 weeks. The longer you're on the market in a faster decline, you're just writing checks. So I want you guys all be aware that this is still a good time to sell, and it's going to be even a more terrific time to buy. You're going to be on the right side of this, and it is going to be something where you should be watching. You should be watching what the economy is thinking, what next phases. You should be checking in with your professional. The longer we wait in a declining market, the less equity you will possess. And so anyway, I hope this video was helpful for you. My name is Liz Jones, and this is Local Living. And please like below, come back and enjoy our next video. Thank you very much. Until the next time.
Thank you for listening to Local Living Tri-City. Stay tuned for more insights and stories from Temecula, Murrieta, Menifee, and surrounding areas. Be sure to subscribe, leave a review, and share this episode with a friend that is passionate about the Tri-City area as you are. Goodbye for now, and we'll see you next episode.